Hey, folks, if you haven't done so already, please click that subscribe button below. That'll help us grow as a show, attract better guests. Together, let's make healthcare better for everyone. Once again, click that subscribe button. We'll see you on the next one.
Get ready to take control of your healthcare. Here's your host, Ray Kober.
And we're live, ladies and gentlemen. Welcome to Broken Healthcare. My name is Ray Kober. I am your host, and I am delighted to be joined today by Phil Holowka and Rob Zwirn. So nice to have you in the studio, folks. Two for the price of one today. What's going on, Phil? How you doing?
I'm doing wonderful, Ray. Thanks for having us.
Of course, it's great to have you here. Phil, now the name of your company is Complete Captive. Mm-hmm. And so we're going to talk about captive insurance today.
Love it.
And as I understand it, Rob over here is actually one of your clients.
He is.
So yep. Rob, welcome. Maybe let's start with a little bit of your background, Rob. You're a CPA by trade, and how did you guys, get to know one another?
Sure. So yes, I am a CPA. I'm the CFO of a company called Action Ambulance Service, and we are one of Phil's clients. I've been with Action coming up on 8 years, and prior to that, I had never known Phil. I never knew anything about captives, and it was eye-opening. It was a great experience, a great introduction. And I've learned a lot, not only from Phil, but from, just the resources that are available about what are captives and how can they help us as an employer.
Awesome. So Phil, how did you get to know Rob? Where did your paths cross? Was this cold call? Like how does this happen?
Yes. So Rob's boss, my friend, Mike Wonka, we've been friends for probably the past 20 years.
Yep.
And Mike and I have stayed friendly with each other all of those years because I don't know if you know this, I was a paramedic once in my prior life. So that's why MedTrans insurance has an affinity to ambulance companies, and that's where I met Mike, which is Rob's boss.
Got it. Very cool. Yep. So tell us exactly what is a captive, because I think part of the issue, for lack of a better word, in the insurance world is where the folks who are healthcare consultants, as I am, or benefits brokers, right, mm-hmm. the more commonly used term, mm-hmm. tend to, if you look at a traditional insurance structure, they tend to color within the lines. Mm-hmm. And what that means for most people is fully insured solutions. If they're progressive, it means some form of self-funding, mm-hmm. Level-funded coverage. And a captive is like it's throwing another monkey wrench into the deal, if you will.
Yep.
But this is, maybe you could give us a little bit of a flavor for, kind of, I don't want to go way back, but how did you get involved with captives? I'm sure you didn't start, it wasn't a straight line between, I'm sure you went to school. I don't know if you have college in your background or not. Maybe yes, maybe no. But from the time that you exited school to getting to the captive, what does that look like for you, Phil?
Oh, boy. So I zigged and zagged throughout my life. So I had ambitions to go to medical school, and I had taken a course called an emergency medical technician course because I wanted to have more experience and knowledge of medicine.
Yep.
And when I signed up for the course, I didn't even realize that it was for ambulance operations. So I was in college, I was an EMT, went to paramedic school, and at the time I was making a fairly decent wage as a paramedic. And I quickly learned that EMS, being a paramedic in the field, is a young man's game.
Yeah.
So, and as I was not becoming a young man anymore, it became clear that I had to find a new route to go down. So, I got out of the field and I became the executive director of an ambulance association. And those members were ambulance companies, Mike being an Action Ambulance being one of them. They said, what you're doing is good, but we're really getting slaughtered by health insurance. What can we do as a group to purchase health insurance?
Oh, wow.
So that was the precipice of how MedTrans insurance got started. And then here we are today.
So that's crazy. So there wasn't, when I talked to many guests about kind of their path and how they, as you say, zig and zag before they land on insurance or healthcare.
Yep.
In your case, though, you were actually thinking about becoming an MD. You were a paramedic, right? So you're working in an ambulance and helping people. And you have this epiphany that, hey, there's only so long I could do this.
That's right. That's right.
But then, the thing that's striking is you actually made a pivot directly into captive insurance.
Yep.
And so that's remarkable to me that there weren't. Let's almost call it a zit. It wasn't a zigzag.
Yes.
Right. In your case, it was really kind of pretty quick. How did you stumble on this idea?
Well, it's all about knowing the right people and having people help you develop your ideas.
Yeah.
And so I was fortunate enough to meet the right people that helped me develop the idea that I had of aligning all of these ambulance companies together to get better purchasing power on health insurance. And quickly, I'll fast forward to where we are today. We had to stand up an insurance company. And if you ever want to be told no 9 times out of 10, try to stand up an insurance company because everyone's trying to say no to you. And ultimately, I found people that were more willing to say yes than to say no. And MedTrans Insurance was the result of that. And it's been a ride and a blessing since then, way back in 2009.
So that's you're in the game now. What, 13 years?
15 years.
15 years. That's math wasn't my specialty, I guess.
That's right.
15 years, and so define what you mean by stand up an insurance company. Are you an insurance company?
We are. So by definition, a captive is a private insurance company. So that means it's the insureds that are receiving the policy can only own the captive. So in other words, if I owned the captive, I cannot sell an insurance policy to the commercial public.
Okay.
So by definition, a captive is a private insurance company.
And so is this regulated by each state's Department of Insurance? Does it fall under ERISA, so it's national? How does that work?
So we are regulated by our captive domicile state. And in our case, Nevada is our regulator.
Okay.
So there's about 30 or so captive domiciles across the country, Nevada being one of them. Vermont's a big one. South Carolina's a big one. So you just have to follow the statutes and the regulations just like a commercial insurance company does.
Right.
Yep.
Got it. Interesting. And so, Rob, how does it kind of I understand the connection, right, between the two of you. He was working in the field that you're in, essentially. And I think, it's not uncommon for folks to pick a flavor of profession, sales, being one of them. It's not at all uncommon for people in sales to call on what they're familiar with, right? So that, that lines up perfectly well. But still, you have Phil, who's an introduction by the business owner. And what is, well, let me ask him first. What is the pitch?
Well, the pitch is simple. So you can enrich and empower the insurance company that you have no control over, or you can own your own insurance company and empower yourself. Every single month you write the premium check. It's that simple.
Okay, but so I'm going to push back on you a little bit, Phil.
Sure.
Because, so the tough part about the insurance business is, and I don't care what you're doing out there, even if you're an MD, everybody is selling something, right? So I'm going to use a dirty word and say selling. So we're selling an intangible. It's something that you can't touch. If I sold you an apple, you'd say, okay, is it ripe? Is it about to ripen? Is it rotting? What's the story? It's easy for people to hold something and touch it and say, aha, it's an apple. I get it. What you just said doesn't make any sense. at a high level, I understand what you're saying, but dumb it down for me. Like, what is really going on?
Oh boy, you got to unpack that.
Yes.
So the captive itself functions no different than when you buy a commercial insurance company issued policy.
Okay.
Because at the end of the day,
Yep.
if you're in a BUCA plan, a Blue Cross or an Aetna plan,
Yep.
you're in Blue Cross's captive.
Okay.
Okay. Now, the piece of paper that you get from Blue Cross, the policy, we give you the same thing. We give you a policy, has words on it, right?
Yep.
Signature page.
Yep.
So what you say about the intangible is a real thing, but what we try to distill down is participating in a captive insurance arrangement is not for the faint of heart.
Okay.
You have to be a sophisticated employer to be able to conceptualize exactly what you're saying. And once you conceptualize it, it makes sense. So that's why I always say, and there's a lot of messaging out in social media, captive insurance is not for everybody.
Yep.
So make that clear.
Yep.
It's not for everybody.
Okay. So let's suppose I want to take that out of it for a minute.
Okay.
We're gonna go to baseline just to say when we're making an assumption that you've just stated is not true, but just for humor me for a minute.
Sure.
Let's suppose the captive insurance was for everyone. Mm-hmm. You have a policyholder who has coverage with Blue Cross. You have a policyholder with coverage through your company. Mm-hmm. Is there any difference to that policyholder, talking about the employee or their spouse or their children, or does the policy itself function exactly the same?
I see Rob nodding his head over here. So yes, it does. It functions identical. Yeah. The employees see nothing of the captive insurance arrangement.
Right. Okay. So having said that, when you say it's not for everyone, are we talking about the size of a group? Are we talking about the experience of a group, meaning how well they're performing in terms of claims? Are we talking about both of those things? How should we think about? So I guess the question is, what's appropriate for a captive? And I'm not going to let you answer that. I'm going to let Rob answer it, because I'm sure that Rob must have gone through this analysis when he was considering your pitch.
That's right.
So tell us, Rob.
Sure.
So I'm sure you had a lot of questions, because this is not like connect the dots, easy to understand, wrap your brain around from point A to point B. What were some of the things that you questioned about? Is this appropriate for our business?
So, full disclosure, when I started with Action, the company was already participating in a captive, actually in two captives, a medical captive that was different from Phil's structure, and our workers' comp captive.
Yep.
So there was some knowledge that was able to be passed on to me. My background, all my prior companies, and even coming out of public accounting, I'd never seen a captive before.
Yep.
I'd always been involved with, a Blue Cross direct written premium or Cigna or Aetna or whoever it might be.
Yep.
The thing that when this was explained to me, the thing that really stood out is the amount of control that you, the company, has over the policy. We get to go out to market to find it. So right now we currently use Cigna as our network.
Yep.
We could go out to market and look for a Blue Cross, a United Healthcare, an Aetna, Cigna, Harvard Pilgrim, whoever. That part of the policy is exactly the same as if we were in a traditional marketplace.
Yep.
The difference is we get to take control over what really is covered under the policy. What are the limits that we want to put around it? How much risk are we, the company, willing to take on? And we can set our own retention limit. We have reinsurance that covers if there's a spec hit above our retention limit,
right,
the reinsurance kicks in. We get that benefit. One of the things that really stood out when I started looking at it is cost. To the employee, it's no different.
Okay.
I have my copay, I have my deductible, or no deduct depending upon the plan.
Right.
The ultimate premium dollars and funding dollars, the claims that we're paying, is where we can save, the company can save a lot of money. So I look at it as if I was in a traditional market, and this goes back to my prior employers when I worked on the renewals, we were spending about, in total premium, both the employee paid and the employer portion, was about $25,000 per employee on an annual basis. So you multiply that over X number of employees, it adds up very quickly. My experience with the captive, we're less than 50%. I'll be generous and say we're at 50% of that cost. And that's
how many employees does your firm have?
We have 325 employees, about 75 to 80 on the plan at any given time.
Okay.
Not everyone obviously opts into benefits. They have benefits elsewhere.
Sure.
But just taking that same 75 to 80 employees and multiplying by 25,000, comparing that to what we're spending on an annual basis, and there's significant savings to us being in the captive. And those savings, from the CFO perspective, that drops right to our bottom line. That's dollars that we're retaining to either reinvest in other benefits, our employees, equipment, whatever it might be. Those are dollars that we're able to use elsewhere.
Okay, so that's interesting, right? So when you look at a business, any business, even a nonprofit, I would argue, ultimately it's really about returning value to shareholders, right? And so in your business, I would imagine you're for-profit?
Yes.
You are for-profit. And so when you look at healthcare as an expense, generally it is typically a 1, 2, or 3 expense after payroll, right? I don't know if that's true in your case or not, but it's a pretty healthy expense. Yes. And so in a traditional plan, you have no control over how that plan runs and functions, if I'm talking about fully insured. And the truth is, for many, 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 I would even venture to say most self-funded or level-funded plans, there's really no mechanism for controlling claims. Claims is 80% of the expense in healthcare. And so did you need to get an education about this prior to taking the leap and understanding? Because everyone loves the idea of saving money, right? If we can save money, and particularly with a top SG&A expense, every dollar drops straight to the bottom line. If you're trading at a 10x multiple and you could save, $10,000, that's $100,000. And if we're talking about big dollars, you could be talking about many millions of dollars. And so when you look at this, does that come together for you like big picture instantly, or does it take you a while to just kind of understand, hey, it sounds all well and good, but what is the risk reward, and how do we go into this with open eyes, knowing and appreciating that we're going to produce the savings that we think we can.
Right. Going in with open eyes, you still have to understand that there's always that chance. There's always that chance that there's a lot of claims, big dollar claims that could hit you. Right. Or you can get lucky and have a great year and you just have people going for their annual physicals. Yep. And you never have that, the child in the NICU or a pacemaker installation. You don't have the big ticket items. Yep. And there could be years where you have a lot of those. So you have to understand up front that maybe there's a chance that we will be taking a spec hit. Yeah. And we could be on the hook for whatever's over our retention on multiple claims. Right. And luckily, Phil and Complete Captive and the actuaries can look at this and say, well, your premium is based off of actuarially, if that's the word, actuarially, how many employees or how many individuals do we expect to have a severe event? We can control certain things, or we can help change the habits of our employees in certain areas. Not everything. Right. And that can help us, and we can design our plan to help us keep some of those costs down on purpose. You can put limits on how many certain treatments can be used, how often or how frequent new treatments can be put in place. New treatments being, for example, like gene therapy. And Phil probably knows a lot more about that than I do. But do you allow the experimental procedures on day one, or let's wait a couple of years and let those be proven before we start incurring, for argument's sake, $1 million of expense?
Right.
When 3-4 years from now, when it's proven to work, it may be a fraction of that cost. We can exclude stuff like that. We have those levers that we can pull. But we can also help identify with, we're lucky we have resources at Complete Captive who can help us review claims.
Right.
We actually can look at details of certain claims and figure out, okay, is this an individual that we need to help or we need to approach and help them in their medical treatment plan? Is there a pattern that we're seeing? Are we finding, and this, I'm just making this one up, do we find that a lot of the employee base go to the emergency room as opposed to having a PCP? And if we can identify that based on data that is actually shared with us, we can approach our employees and say, look, why don't you go to a PCP or even urgent care as opposed to going to the hospital and sitting in an emergency room and racking up not only significant costs for us, but higher copays for you.
Right.
And that's data that you typically don't get, at least my experience, that you typically don't get from your standard, your traditional BUCAs.
Right. Let me unpack a couple of things there. So one is, it's not all about the money and the savings, right? I'm sure that, when you looked at this, as attractive and as alluring as that is, you have to take other things into consideration, such as recruiting, retention. But beyond that, I think most employers really care about their people. And so you have to ask yourself, I hate to use the word disruptive, because anything that we do that requires change, even if it's minute, we can use the word disruptive. And I think folks in leadership need to kind of step away from not doing something for fear that it might be disruptive, because 9 times out of 10 in my experience, it's such bullshit. It really, people get over stuff. We don't give people credit enough for adopting and changing. And there's always going to be someone who complains, and those people scream bloody murder about the slightest things. So that's one aspect of it. I think I'm sure for you is just understanding, what is this change going to look like? Because I think it's important to think about that. But then the other thing that I want you to talk about is most employers that are not in the know, that venture into the self-funded, level-funded space, are of the mind that they can have access to employees' protected health information. And the truth of the matter is, it's not that they can't have access to it, it's that they can't take action, probative action. Am I using that word right? You can't punish punitive action. You can't punish an employee and say you're fired because you have a cancer diagnosis, right? And I mean, forget about the moral implications of that, which are horrific. But there are legal ramifications. But when it comes to identifying members and having access to their data, there's actually an advantage in that you can help the organization and all of the employees, but also help the patient. And so is that something that worried you when you kind of went from fully insured to self-funded and then with a captive? Or was that a concern, and what helped you get over that? So
2 things. I think the first thing I'd like to point out about being disruptive, from the employee's perspective, and my take on this is, the biggest disruption is when you change from Blue Cross to Cigna.
Yeah.
The employee, that's what they care about, is my doctor in the plan, in the network.
Yeah. And
in our case, they are. I mean, if we've made a change, and we have made a change in the past between the carrier, it's easy enough for us to validate that 99% or 98%, whatever it might be, or even 100% of our employees' providers, regular providers, not the one-offs that they may have seen 10 years ago, but their primary care, their vision provider, whatever it might be, they're in the replacement plan. And that's, for the most part, what the employees care about. Can I go see my same doctor? So we focus on that. The other thing is, with that data, now you do see you can get access at the name level. For me to act on it, it's meaningless. But what we can find out, what some of Phil's tools can help us identify is who are there individuals that are leading to higher costs that we're able to talk to the employee about, or have a doctor or a nurse who's working with the carrier.
Sure.
Reach out to them to help them in their medical plan.
Yeah.
The place that I see it most often is, and this is probably a simple example, is we have a pharmacy benefit manager that can reach out to certain employees and say, look, if you get your medication through us, it's only going to cost a fraction of what you're currently paying by going to CVS or Walgreens or wherever you're picking it up.
Right.
And for certain meds, that's the employees, as long as we can't push the employees to do so.
Sure.
But if they're willing to switch over to receiving it through the mail,
sure,
well, why not? Because
right,
they're saving money, and ultimately we save money. Excuse me, as well.
Right.
Right. And the employee, it's agnostic. I'm getting my meds.
Yeah.
I can see the same doctors.
And that's huge, because if you're in a traditional, we call them in the vernacular in our business is the BUCAs, right?
Mm-hmm. Yep.
Blue Cross, United, Cigna, et cetera, et cetera. You don't have that control and that insight. And when you don't have that control and you don't have that insight, you're not in control. And then the plan is being managed instead of for the benefit of your organization and your people, it's being managed for the shareholders of the big giant insurance carriers. And furthermore, when you dive in and you look at, hey, we're with United and our PBM is OptumRx. Well, one thing is for sure, you're paying the most that you can possibly pay for insurance coverage. But when you're in an independent plan, as you are, and you have an independent PBM, pharmacy benefit manager, that is not tied to a BUCA and is therefore not tied to the BUCA revenue model to pay their shareholders, then you could also jump in and with the insight that you have, you can look at a particular employee and maybe they're on Humira, which is, a very high cost drug that's, prescribed for rheumatoid arthritis and other autoimmune diseases. And it might have a ticket upwards of $10,000 or $20,000 a month. Mm-hmm. These are very, very costly drugs. When you have that insight and you can identify a member on the plan that's taking Humira, they may qualify for a patient's assistance program, and that drug could be delivered to that patient for free. Yep. Free to the employee, free to the organization, and that's a win for everyone. So I think those are some examples of why.
Yep.
So Ray, go ahead.
I was just going to comment right on that. We had an employee who needed a very significant dollar medication. They had it administered in a hospital. Mm. It was identified shortly thereafter. Once it was approved by the carrier.
Sure.
It was identified, and we found out that, look, if they went across the street to an outpatient center, same medication was significantly less, like 6 figures less.
Wow.
So we said, look, to this employee, we know you need it.
Yeah.
Continue to get it.
Yeah.
Just go across the street.
Right.
It literally was across the street. And the outpatient center was across the street from the hospital.
Yeah.
And it's it's been fine ever since, or his treatment's been fine since.
Sure. And what we find in our practice as healthcare consultants is when you actually design plans, and I'm not sure that yours is set up this way, but when you design plans that give employees and members options, then hey, if you want to pay full sticker price, it'll cost you what you were used to paying on the other fully insured plan. But if you accept our steerage, and steerage, quote unquote, is like, no one wants to be steered. Well, you might want to be steered if we're talking about 6-figure savings to the organization. Yeah. And, if you're an employee that's listening, you might say, I don't give a rat's ass about my boss and my organization. Well, you should, because every time your plan is taxed, and I'll use the word tax, with these egregious RX costs, everyone is paying for it in the end. It's costing not only your organization, but you bet your ass it's costing you and your fellow coworkers huge amounts of money, particularly when you look at compounding over time. So really, I think everyone needs to join hands together and say, ultimately I do have a choice. And there may be certain circumstances where, I don't know, you feel hell-bent about a particular surgeon and you have to go to that surgeon, and maybe you're referred to another surgeon that's got awesome quality scores, but you just decide, no, you know what, I'll pay my share. The plan will pay its share. That might be a one-off that I would be comfortable with. I think most employers would be like, sure, we're not here to dictate, to our people what they're going to do. But when they have skin in the game and you can motivate them with not only money, but also prove to them that we're not just sending you to, Surgeon Rusty Nail down the street, right? Rusty Scalpel. We're sending you to a place where they do a ton of these procedures with flawless results. And so you're in very good hands. It paints a completely different picture. So getting back to you, Phil, your model is not conventional. Would you agree?
Sure.
Okay. And so when you say it's not a fit for everyone, who is it not a fit for?
So the class of trade generally that lacks interest in this model is a municipality, a government entity, because at the end of the day, they may strive for lowering costs, but sometimes that's against maybe a union motivation, or a municipality has to go out shopping every single year for their stop loss coverage. And our model is not necessarily I got to tiptoe on how I say this. Premium pricing is not the primary reason someone should go into this.
Okay.
So premium pricing is when your captive underwrites you for your premium, that is what you have earned. Okay. Now, in the commercial market, do you know your renewal was earned or unearned? You don't.
Yeah.
Okay. So in our model, sometimes the taxpayers want to have an expense at someone else's expense. For example, if a municipality goes out to bid and gets 5 quotes, they're going to buy the cheapest quote, probably because of statute.
Okay.
They have to. In this model, you're paying premiums to your insurance company. Therefore, you want your insurance company to be solvent, and you want to be able to cover your own expenses or your future costs. So it's a little different optic, but what goes behind that is the motivation to control your frequency. So if you own the insurance company, you are now a shareholder and a policyholder. When you buy a BUCA policy, you're just a policyholder. There is a distinction there. So when you align the incentives, becoming an owner of that insurance company is proper motivation.
Got it. So when we look at fully insured versus moving to a model like this, what I'm hearing is that you're gaining insight into your plan, you're gaining control into your plan, and if your plan performs well, you participate in the savings of that plan performing well, whereas you have no hope of doing that in a fully insured model.
Correct.
Okay. So that's one thing. And then on the flip, though, in a fully insured plan, sticking with that for now, they are pretty much indemnifying the employer if the shit hits the fan and you have a $2 million heart transplant, you're covered in a fully insured scenario within limits, but your exposure is capped. How does that work with you guys?
So we do have catastrophic exposure coverage. So there are numerous solvency controls that are put upon us by Nevada, who regulates the solvency of the captive. So we have to comply with those, and we purchase different layers of insurance on it's stacked for an easy explanation of it. But yeah, you give me an employer with 1,000 employees, I'm going to tell you on day one that you're going to have this many claims at this range and this many at that range and this many at that range. That's the general average.
Yeah.
So when you buy a commercial policy, the Affordable Care Act has set forth the minimum loss ratio, right? You remember that 15, 20%?
Yeah.
Well, to me, the accountant side of me, that translates into if you give $1 to Blue Cross, you're getting 80 cents worth of benefit or 85 cents worth of benefit.
Yeah.
When you're self-funded, you give $1 to pay claims, that dollar is paying $1 worth of claims. So the stop loss premium that is paid into your captive also has a lower expense load than what the commercial policies offer. So you have some efficiencies there with a captive arrangement that you don't even get, even if you would buy commercial stop loss insurance. So
interesting. Yeah. So I think there, like Pareto's principle does apply to healthcare and, with respect to claims particularly. And what most people don't really understand the mechanics of it. They're focused on, their everyday business, right? They're not trying to dissect how $1 is split in their plan. But you raise a good point. So with healthcare and the MLR, the medical loss ratio, 80 to 85 cents of every dollar is meant to pay claims, and people say, that's as it should be. That sounds fair. The lion's share of the dollar should be going to pay claims, until you realize that there's another 15 or 20 cents to talk about. And what happens with that? Oh, well, the insurance carrier gets to retain that for administrative overhead and profit. And so how do they make more money? Well, claims have to increase.
That's right.
And that's a huge red flag, and it's something that I frankly hope gets repealed in the Affordable Care Act, because in my opinion, my humble opinion, that's got to go. There's no such rule in a captive insurance arrangement, and to your point, that entire dollar is earmarked for claims, and so that's a huge thing. Episode of Broken Healthcare Podcast is brought to you by Benefixa Healthcare Consultants. Visit benefixa.com to learn what's possible. Reduce the cost of healthcare for your organization, deliver better outcomes for your people, and yes, design health plans that give your people a path to $0 out-of-pocket costs for healthcare. Visit benefixa.com today. So in terms of the design of the plan, because you had said, Rob, that your plan is basically, in terms of disruption, you kept them with Cigna or Blue Cross or whoever the carrier was. You wanted to make a decision to keep that the same. So, I guess this is really your question, Phil. How is it that you can have a self-funded model and a captive model, but a major insurance carrier network? How is that possible?
So the employer is simply renting the network access. So BUCA, Blue Cross, United, Cigna, Aetna, they will grant access to their network for a fee. That's a per employee per month fee that an employer can contract with Cigna, and that allows the employees to feel like they have a Cigna coverage. The funding mechanism behind that is not really of the employee's eyes to see. They don't care how the bills get paid.
Got it. So the answer is you can rent these networks if that's right. Super important to the organization. Then the carrier network and the network of doctors and facilities that are in that network are still accessible to the employees.
That's right.
And that was a big deal for you, I guess, Rob. Ultimately, when you looked at this, what else attracted you about it in terms of the mechanics? How did the mechanics work from a financial accounting perspective? What you were doing before versus this scenario?
Well, I think the big thing that really comes into play is, as Phil said, that you as an owner, as a stockholder, you get essentially a return. You're earning whatever's not spent in the plan.
Yep.
out of your premium dollars, those not unpaid claims, but whatever the dollars are that are left in the plan after claims are paid.
Yep.
That's your profit. Now you get the benefit of that after a run-out period coming back to you. But you also get the benefit, and I know this is how it works with Phil. I don't know if this is how it works with other captives. You get the benefit of your premium dollars are paid in, and they're invested in the meantime. And you earn, at the very least, you're earning some interest back that gets allocated back to you at the end of the year. So I've got additional sources of income coming back into the company if we choose to take it back. We could leave it in the captive, or we could elect to take it, and it's taxable as a distribution. But if we leave it in the captive, we know that, okay, we've got money sitting there in the event of claims that are exceeding our premium dollars. We could use those, or if we someday want it, we can pull it back to the parent company.
Interesting.
So I'm going to geek out on some accounting principles.
Please.
So for our CPA friends that are listening, because you are the sole owner of your captive, it's considered a subsidiary to your business.
Okay.
Your business owns the captive. You're going to own 100% of your business, your captive insurance company. So you're going to be able to expense the premiums that are deposited into your captive, and then ultimately you're going to consolidate the financial statements between both entities. So what that'll, in essence, that's left pocket, right pocket transactions. So you're literally picking up an asset every time you write a check to your insurance company, which is your captive. Today, if you're buying it from a BUCA, you're simply picking up the expense, and that's where it ends. So this is literally, you're turning an expense into an asset by owning your own captive.
Okay, so I'm not an accountant,
Yes,
right? But I understand debits and credits, and what I'm hearing you say is that you're essentially taking an expense, a debit, and you're moving it over to a credit essentially from one entity to another entity, and the other entity being the entity that you create for the captive.
What better arrangement could you ask for?
Very, very interesting. So why isn't everyone doing this?
Well, I think it boils down to the common bond of this captive arrangement is really sophistication. For consultants that want to embrace and learn this, they ask the same question, right?
Yeah.
I mean, it's like, well, why are you not doing it? We've turned our heads to employers at times when they say, "Oh, Phil, I love this product.
Yep.
I love it more if you can knock 10% off." And that's when the ball just drops, and I walk away, because that employer, CFO maybe or CEO,
right,
they don't get it.
Right.
Because this is not a transaction.
Right.
If you're looking to buy the cheapest policy, we're not necessarily it. Now, we're not more expensive than the market.
Right.
But why on earth would you not want to fund your own insurance company so that it remains solvent?
Right. Yeah. That's kind of ridiculous.
That's right.
First of all, in insurance, you couldn't do that. Insurance is regulated.
Yes.
And you can't offer a cheaper price or a discount in the traditional insurance world. So someone asking that question, clearly doesn't understand the whole dynamic.
That translates to me that they're short-sighted.
Yeah.
Because you can either pay $100,000 to the BUCAs, or you can pay $100,000, call it $110,000 to your own captive insurance company.
Yep.
Well, if you do a good job and control your claims, you're going to walk away with $60,000 at the end of the year.
Yeah.
Do you want a pure expense, or do you want a $60,000 asset?
Sure. Yeah. Well, and not only that, but I liken if we go back to a standard insurance model, whether it's level funded or whether it's fully insured, most of those plans are being managed looking in the rearview mirror.
That's right.
So the broker walks in and comes in with flop sweat and says, Blue Cross, they asked for a 30% increase. And it's 30% on what? 30% on what we paid last year? And how did they come up with that number? Yep. And they're like, oh, don't worry. We negotiated it down. They went back and they wanted 20%. We said, no, that's not good enough. We went back again.
Yeah.
We got it down to 8%. And then everyone's doing high fives, like something wonderful just happened. And I'm like, you motherfuckers don't get it.
You don't.
Compounded interest on 8% when you're talking about millions of dollars.
You don't.
I'm not interested in playing that game. Yeah. So what you're really referring to is managing the cost of insurance prospectively.
That's right.
In advance. And that is the way to do it for sure. Help me understand what your particular captive's differentiator is, because there are many different companies that you could find out there that will offer a captive insurance policy. What's your secret sauce?
So the garden variety group medical stop loss captive, and I could rattle off probably 10 names that consultants have heard in the past. They're all set up identical. They are a group captive, so one captive, one EIN number. They are a reinsurance captive, which means there's an admitted stop loss insurance company between the captive and the client that is acting as a front. Okay, so in those arrangements, the fronting carrier and the captive all have expenses. The care and feeding expense of both entities need to be satisfied, and that expense is baked into the premium. Mm-hmm. Okay, our model is we bring a single parent captive solution to the employer. So the employer is the sole owner of their own captive insurance company, 100%. And then we don't have a fronting carrier. So we are what's called a direct writer captive insurance company, which means the client's captive actually issues the policy to the insured, the employer. Mm-hmm. So we do not have a fronting carrier or any other intermediary that, frankly, strips profit out of the premium pricing.
Mm. Interesting. And so does that matter in the math at the end of the day? In other words, if you're in one of the competitive captives that are out there in the market, and they're a single group captive doing things in that manner, all claims being equal, the bottom line going back to the employer, is it more with you guys or less with you guys, or can you even figure that out from my convoluted example?
Oh man, I can tell you in a heartbeat, and I'll let Rob also answer part of this question. The group captive is going to have an expense load, much like the MLR.
Yep.
An expense load of 35, I've seen as bad as 50%. So that means for every dollar going into the captive to pay stop-loss claims, 50 cents or 35 cents are going to third parties, leaving less money to pay claims.
Okay.
Rob's on our finance committee. I'll put him on the spot and ask what our expense load is.
The expense load is, I believe it's 12%.
It is 12%.
It's 12%. So literally a fraction of what a larger group captive could be charging.
Sounds like on average about a third.
It's a third.
Yeah.
Yeah.
So
that's huge.
So that translates into just more money to pay stop-loss claims.
Mm.
So if the employer has the same claims across multiple captives,
right,
that means your single parent captive is going to have more underwriting profit left over.
Right. Interesting. Yeah, and what I'm hearing, like just kind of dumbing it down, is that there are more hands in the cookie jar in competitive captives, and ultimately that's taking away from the bottom line of the organization. Is that fair?
I label it as the tail is wagging the dog.
Okay, so are you guys the only captive that you know of that does it the way that you do it? Are there, not for you to name names, but are there others out there that do the same thing that you do, or are you unique as far as you know?
So we are unique on several fronts. There are some captives that direct write policies, and there are very, very few of them, maybe one or two other ones. There are other single parent captives that are reinsuring a commercial carrier's policy. So like a group captive, but for single employers, generally they are larger employers.
Yep.
To my knowledge, we are the one that kind of blends both of those values together into one structure that is deployed down to the employer.
Interesting. Very cool. So it sounds to me like you definitely have somewhat of a competitive advantage there.
We have lightning in the bottle.
Lightning in a bottle. That's pretty good. So shout out to my old employer, Sam Goldstein at B&H. He used to tell me, I told him once we were at a trade show together, I said, Sam, it's as good as sliced bread. He said, no, Ray. I said, sliced bread, it's so perfect. He said, nothing could be that good. And so lightning in a bottle, interesting. Can it be that good?
It is good. Tongue-in-cheek, jokingly, I will say to an employer, you give me 5 years, I'll give you hundreds of thousands of dollars of underwriting profit. Hundreds. And he is a testament to that as well.
Well, if not millions, right? It depends on the spend.
Yeah.
So help me understand, maybe you could help me, Rob, with the numbers. So I'm estimating you're spending what, somewhere between 2 and 3 million with your population or more?
No, actually we spend a good amount less.
Good amount less.
Good amount less.
But so that $25,000 per employee per year that you mentioned, that was before.
That'd be in a traditional marketplace, if it was just direct written with Blue Cross or Aetna or Cigna.
Right. So now under the auspices of Phil's company, Complete Captive.
Yep.
I want to make sure I got that right. You're spending a fraction of what you used to spend.
We're spending about 50% of what the traditional marketplace would have us spend.
Wow.
And that is before any underwriting profits or the interest income that I mentioned earlier comes back to the company.
Yep.
Right. And so ultimately for you guys and your head of finance in this operation, what is having that extra capital mean for an organization? Or I don't know a whole hell of a lot about ambulance companies. Are they madly highly profitable? Are you are you scrounging for every time? Basically, yes. Tell me, give me like is this meaningful for an organization like yours?
It definitely is. And think of it as, and you probably know more than I do about medical pricing. Medicaid. So when we get a call, an emergency call, an ambulance response, we don't get to go out and say, oh, you have Medicaid, you have Medicare, we only deal with we have to go and respond. So we don't know if the person that we're transporting, the patient that we're transporting, even has the wherewithal to pay. So the range of dollars that we could bill and or collect from that individual could be anywhere from zero to thousands of dollars. Depending upon the communities you serve, you could be picking up a lot of people at the low end, or a lot of zeros, or a lot of people at the high end. And again, you still don't know what you're going to collect. So any savings that you can generate from another line item, medical insurance, helps on the bottom line in that it helps support staff salaries. It helps supports repairs to your equipment, even new equipment. It can underwrite or help support paying premiums for other line items, workers' comp, GLPL, whatever it might be.
Sure.
You mentioned earlier, insurance is number 2 or 3? Yeah, insurance is the second largest expense that a company or our company has across all lines. And being able to reduce that expense anyway is helpful to the company. You can imagine during COVID, nobody was going in an ambulance. So we made it through. And a lot of ambulance companies did, but there are several, I can name a couple, that did not. And a lot of that is you're able to control, if you have the ability to control some of your expenses elsewhere.
Sure.
It helps.
Yeah. So I not an accountant by trade, was kind of bored to tears in my business classes. If I'm going to be honest, in college, and that's a whole other story. I jumped around. I declared an English major of all things, and I was like, no, the hell am I going to do with this? I ended up on a communication arts major, which is why all this fucking equipment is here. So ultimately, when I look at this, I look at operating expenses because even though I don't have a business degree, I've later been a student of the game. And operating expenses are something that you really have to pay attention to in an organization because they can eat you alive.
Well, it's the same as applicable for captive insurance.
Yeah.
Consultants, there's a certain sex appeal about captives at the moment.
Right.
And consultants are turning a blind eye to the cost of a policy.
Sure.
Because a consultant could go to the commercial market and I would argue buy the same policy for less of a premium price than in a captive.
Yeah.
Now, why is an employer looking or willing to pay more in a group captive with the hopes of getting underwriting profits back at the end of the year? So this market, the captive space is an interesting space at the moment.
Yeah, yeah. Well, I think you guys have done a great job kind of laying out what your differentiator is and why employers should, at the very least, I think they owe it to themselves, and particularly now with the passage of the CAA, being a fiduciary, being named as a fiduciary to the same extent, you're on the hook, Rob, to the same extent that you are, with your 401k plan or your retirement, planning. You can actually be sued personally if you're spending plan dollars inappropriately. Okay. So I would think at the very least an employer would want a consultation, or they'd want to understand what the hell is this and make it real. So how do you make it real for an employer? Is there can you look at their numbers? Typically, what do you need in order to produce, I would imagine, a projection?
Mm-hmm. So if they're already self-funded, we could very easily take a look back 5-6 years. If you give me their premiums and their claims, I can run them through our experience and say, hey, had you had a captive within us, within our risk pool, you would have X underwriting profits. X dollars in your captive. So that's easy. The bigger question is the willingness to engage, right? That's if the employer is looking to buy the cheapest insurance or not participate in what it takes to run an insurance company, which we do all the heavy lifting, but we need the employer to engage, and that's important.
So define engagement for me, because people are going to hear this and they're going to be like, I got enough shit on my plate. It sounds great, saving hundreds of thousands or even millions of dollars, but that's why I have, Marsh. That's why I have Lockton. That's why I have Aon. That's why I have Gallagher, because I don't want to deal with this shit. And maybe that's not a good candidate for you. But are we really talking about them upending their lives, spending, countless hours a week on something like this? Or what does engage mean?
So I look at it as two levels of engagement. The first level is just taking the time and understanding what the employer has invested in. Because at the end of the day, it's an investment. You are investing in your own captive insurance company. They don't need to get involved in the claims. We do all of the accounting. We prepare the financial statements. We prepare the tax return. We do everything for them. But they have to have a fundamental understanding of the why. Why are you doing this? And I'm not going to mince words. You're doing this because you're frustrated because you paid an insurance company $1 million last year, and they're kind enough to offer you an 8% renewal. Okay? So the first level is just taking the time to understand.
Right.
The next level is participating in the governance. So we will send you, tax returns and financial statements and, documents that need signed. When we send you a document, we expect you to sign the damn document. We don't need to chase you for a signature.
Right.
And I chuckle and you chuckle, but man, that's sometimes a big problem.
Yeah.
So governance participation is kind of the next level.
Yep.
But then from time to time, you own this risk pool, the captive owns the risk pool, and there are governance matters. When we are ready to change a word on the policy, sometimes that requires a vote, right? Because you have the power of the pen to write the words on the policy that is issued to your company. So you need to participate in the governance, and sometimes once, twice a year, we'll send out a matter that needs membership approval or voting.
Yeah.
We expect you to vote.
So that begs the question, is everyone in the same plan in the captive? Are they all designed the same way, or does the design vary from entity to entity? How does that work?
Every employer's plan design is by their choosing.
Okay.
We have no influence in that.
So that said, what type of change are you talking about? Is it specific to their plan, or is it a change that involves all of the other members in the captive?
So it's the stop loss policy. So your captive issues a stop loss policy, which is effectively a cash flow protection policy. Mm-hmm. And the purpose of the cash flow protection policy is to cover the employer against what I call the severity, the big claims.
Sure, shock losses.
And the death by 1,000 cuts, the aggregate.
Yeah.
Now that policy is a legitimate insurance policy stamped by our regulator.
Yep.
So if we discover a change in the market that requires a different usage of words on the policy, that's not by my choice to change those. It's by the collective membership's choice.
Gotcha.
So it's participation.
Participation.
Yep. If you want underwriting profits at the end of the year, we expect you to want and strive for those underwriting profits.
It doesn't sound like you're talking about an egregious amount of time.
No.
Or, well, let's just ask Rob. Is this eating you alive?
Not even close. It really is how much time do you want to put into it. Obviously, if Phil's chasing you for a signature, and if that's all you have to do, or that's all you want to do all year,
right?
That's all you need to do. You could look at the details of every request for claim funding that comes in.
Yep.
And ask questions back, saying, hey. To the TPA, can you take a look at this one claim? I think it's going to be a spec hit, or put it on your radar. I think this is one that's going to creep. Please keep an eye on it.
Right.
If you don't want to look at that level of detail, you don't have to.
Right.
We have conversations throughout the year with Phil and our broker about, are there things, is there anything either changing in the market or that you're seeing specific to us and our users, our plan participants, that we should be aware of that we may want to consider for a change in the future?
Right.
Do we want to consider increasing or decreasing our retention level? How much risk do we want to retain? Mm-hmm. Those are all things that we can choose to spend as much time or as little time on it as we want.
Right.
Now, in our case, I'm on the finance committee, so I spend a little more time than the average participant. Our CEO is on the board. He spends a lot more time than the average participant, but that's by our choice, as opposed to being told, look, this is what you need to do, or not do. To put it in perspective, to go out to the traditional BUCA market and to get a Blue Cross plan or whatever it is, that's the easiest thing to do, in that you're just writing a check. Every month, write a check. Did it go in the mail? Yep. Okay, we're good.
Right.
And it's literally, forget about it. It's as long as it was paid, the check cleared, yep, you're good.
Right.
As opposed to taking the time.
Right.
Or as much time as you want.
Right.
And reviewing and talking and asking questions.
Yeah, and then for crying out loud, brace for impact when your renewal comes, right?
Yes.
It's so what you're describing to me sounds a lot more prudent, right? You're actively managing your plan, and while you don't have to get into granular detail, and most often you probably don't,
right,
having access and eyes on claims gives you the ability to say, hey, let's pump the brakes. Let's take a look at this because this is an outlier.
Yep.
And much the way that I think, some of the best of breed TPAs that are out there will look at claims as they come in, and they'll auto adjudicate, small dollar claims, right? No one wants to spend time on that stuff. But if something pops up and it's like, $150,000 for an MRI,
Whoops.
Well, let's take a look at this one. Yeah. Let's dive a little deeper.
And it's really remarkable that your number 2 or number 3 spend, you're not running your business the same way you're funding your employee benefit plan.
Right.
And if you did, you may have different results.
Right.
So.
Right. So when you look at your book of business, and you say, well, here's I understand that percentage-wise, everything is kind of they fall within a few percentage points, I would imagine. When you look at kind of the biggest wins and you reflect on that, give me an example of like of a group that's an outlier to the good, where like you just can't believe how much money they've saved.
Well, just like any good business manager, I know my numbers.
Yeah.
So our poorest performing captives are getting back on average 8%.
Yep.
Our average captive members are getting back roughly 35%, 33%.
Yep.
Our best performing captives are getting back 72, 75% of their money.
That's insane.
Yep.
72, 75% of their money. So on a $10 million spend, if we're thinking about a good size company, a good size organization, you're talking about like $7 million, $7.5 million that's coming back to the organization. That's insane.
I chuckle because it is absolutely true. I can demonstrate the numbers for you.
That's amazing. That is amazing. So talk to me about how people find you. How do people, if they want to learn more, what is the best way for them to take the next step, if you will?
We generally work through consultants. Consultants have varying degrees of proficiency, as we all probably know, just like any other business. The consultants that listen and really sit and just understand the mechanics, they will put their entire block of business with us and never look back. Very seldom do we have employers come to us, and when an employer will come to us, our first response will be, let's have a mutual conversation with your consultant. Because the fastest way to torpedo this is to have a consultant not understand debits and credits and consolidations and gap and all that stuff. And we don't expect consultants to know those things. But I tell you the CFO does. And if you want to differentiate yourself, you talk to the CFO about debits and credits, and they'll say, I've never heard an insurance consultant talk to me about debits and credits and consolidation and tax arbitrage and all these magic words. So that is generally how we are introduced. But if you wanted to do a Google search or look for us on the internet, CompleteCaptive.com is our captive management address. And the captive address is MedTransLTD.com.
MEDTRANS.
Medical Transportation.
LTD.com. Are you on LinkedIn?
We are,
so people can find you on LinkedIn as well. And it's Phil Holowka. And spell that for folks.
HOLOWKA.
Cool. We'll look to maybe put some stuff in the show notes as well there. And how about you, my friend? Where can folks find you if they need an ambulance ride?
Well, there's a number that you can call. I think it's 91 something. I can never remember what the last one is. So we're located. Our website is actionems.com. We're located in Massachusetts, and we cover most of the state and up into New Hampshire. But they can definitely find us or find me on LinkedIn. They can find our company on LinkedIn and social media.
And I would even go so far to say, if you're an employer that doesn't want to engage your consultant just yet, his boss, my friend Mike, will take your call and evangelize his experience. And Rob, you're accessible too. It's just call.
Mike must be a pretty good friend.
Mike's a buddy.
Good stuff. And as I think about this, so I don't know how long you've been doing this, but my son may have taken a ride in your ambulance. He was freshman at BU, and he broke his ankle playing rugby, and he had to be carted off the field. So maybe
it's possible if we were covering the city. We get called into Boston frequently. Boston is a municipal-based system. But we definitely are in the city on a regular basis.
Good stuff. Phil, do you have anything else coming up that you want people to know about? Maybe folks that are in the consulting line of work, are you going to any conferences or anything like that?
Yeah, so we're going to be in Salt Lake City at Ascend.
Okay.
My friend Nelson.
Right on. Shout out to Nelson.
His gig. We're very strong supporters of what he talks about and his consultants in the next-gen space.
Great.
So we'll be there. We'll be at SIA. We go to SIA every year.
Okay.
And then, next year, there's there's 2 captive conferences that we go to a lot too. So
Okay, cool.
Yeah.
So Ascend is going to be in Utah, and that's second week of July, July 7th.
right around the corner.
And then Saya is in September.
September, October,
Something like that,
Yep.
out in Arizona, I
Phoenix.
think.
Yep.
Gotcha. All right. Well, hey, it's been a pleasure having you guys on the big show.
Yes.
Really enjoyed having you. I think I learned something. I hope the audience learned something. And until next time, folks, love always. Take care.
All right, that's a wrap. Hit like, follow, and subscribe, and we'll catch you next time.